What's going on, guys? Yeah, so, home prices are starting to fall. And I've been waiting on this because I got some money on the side. The market is up. Been up a couple $1,000s since, this Russia-Ukraine invasion. And yeah, let's talk about it, because some of y'all might be looking to buy a house like me and y'all are feeling extra thirsty. I know I am. I need this house. And like I said before, the area I'm looking, the house has been going up $100,000, $200,000 easily, which is ridiculous. So let's react to some of this stuff. So this first video is called "What the Media Thinks About the House Price Falling," because no one's talking about it. So let's get started.
Hey, welcome back. It's Jason Walter here. In today's video, I have an update for you regarding the U.S. housing market. I have a new report that I want to share with you today, and this is compliments from the National Association of Realtors. They just released this report today. And in this housing market update, I'm going to share the fact that home prices actually decreased in January, but you're not going to hear this by the mass media. So let's go ahead and dive right into the video, and I'll share all the latest updates with you guys. So if you actually go onto CNBC right now, they said that January home sales jumped 6.7% despite a record low supply of houses available for sale.
6.7%. People are still buying these houses at their max price, which to me is crazy. But some people are saying, I'm listening to construction workers, and they're saying the supply chain is really a real thing, and that there's a chance that these prices are just not going to drop. So, we about to watch somebody who's saying the houses are falling. So, yeah.
It just goes to show how demand is still very high right now, because home sales have been increasing despite the fact we have a record.
It says January home sales jumped 6.7% despite a record low supply.
I'm going to be going over in detail regarding this. Let's actually go into the actual press release from the National Association of Realtors, though. Again, this was just released today, which is the 18th of February. So they said that in January 2022, existing home sales, which, by the way, existing homes are defined by single-family houses, townhomes, condos, and co-ops. In any case, existing home sales rose to a seasonally adjusted annual rate of 6.5 million. That's an increase of 6.7% from the prior month, which is December 2021, with sales up in all major regions. The National Association of Realtors breaks down the nation in 4 major regions. I'll go over that here in just a little bit. They say at the end of December, I believe that's a typo, it should be January 2022. As of the end of January, the inventory of unsold existing homes fell to a new all-time low of 860,000 houses, which is equivalent to 1.6 months of the monthly sales pace, which is also an all-time low. A couple things I want to point out. Because I'm a housing market data nerd, I actually emailed the National Association of Realtors a few months ago and asked them, how do they define or how do they quantify housing inventory in the US? And they came back to me and said that unsold housing inventory, or unsold existing houses, their housing inventory numbers, includes pending home sales. So it's pending home sales plus active listings. I don't necessarily agree with that. I would define housing inventory as active listings, houses that are actually available for sale, not include pending home sales. In any case, that's what they include. Unsold existing houses, 860,000 would include pending home sales plus active listings, the number of houses actually for sale. When you have a look at Redfin, for example, Redfin reports that as of the end of January, we had about 438,000 houses available for sale. And I think that's more in line with houses that are actually for sale and not include pending home sales. In any case, I think it's accurate to say that inventory is at all-time record lows in the US right now, because look at Redfin as stating that there's about 438,000 houses compared to 2017 to 2019, we had approximately 900 to 1 million houses for sale during this time of year. And have a look at this. This is the month supply of houses available for sale in the US. So in order to have a balanced real estate market, we need this number to be in the range of 4 to 6 months, and have a buyer's market, we need this number to be over 6 months. So right now it's at 1.6 months, which is an all-time low. This basically means that all houses listed for sale in January would be sold in 1.6 months given the current sales pace. So a very, very low number. And this is, of course, why home prices are increasing, because inventory is at all-time record lows. All right, so going back to this report from the National Association of Realtors, they say that the median existing home price rose at a stronger pace of 15.4% on a year-over-year basis to $350,300. The key word here is stronger, and also on a year-over-year basis, because I'm going to show some stats with you guys to show how home prices are at the lowest levels we've had in months, despite an increase compared to 1 year ago. So in my opinion, I think it's a little bit misleading to only talk about year-over-year gains in home prices, but I'm gonna be going over that here in just a little bit to kind of give you a general idea about what's really going on. Okay, let's take a deep dive into the number of home sales and also housing inventory in the US. So this is, of course, according to the National Association of Realtors for national existing home sales. So here's the column I want to focus on. This is existing home sales in the US over the last few years, and also compared to the last 12 months. So in January of 2022, we reached 6.5 million existing home sales on a seasonally adjusted annual rate. So at the current sales pace, we would reach a 6.5 million home sales for the entire year. Have a look at this though. So compared to last month, that's an increase of 6.7%. which is quite remarkable given the fact that housing inventory has decreased by 5.9% compared to 1 month ago. So it goes to show how home sales remain very, very elevated despite the fact that housing inventory is at record low levels. In addition to this is the number, by the way, that all the news outlets are reporting on, that existing home sales rose 6.7% compared to 1 month ago, but compared to 1 year ago, we're down 2.3%. Here's something I want to have a look at though, because if we're only to look at compared to 1 year ago or 1 month ago, that doesn't tell us the whole story. So when you look at all this data here, I was noticing the fact that January home sales of 6.5 million, again, this is a seasonally adjusted annual rate. That's the highest levels we've had since January of 2021. So January home sales are at the highest pace we've had, even compared to the spring and summer months of last year, when, of course, last year the housing market was in full swing in the spring months and summer months. So it just goes to show how remarkable we've had 6.5 million home sales despite a record low inventory, and also January, when it tends to be kind of a slower month. Okay, let me give you an update regarding home prices, because as I reported, home prices actually decreased compared to last month, but you will not see this in this report here. So Lawrence Yun, who's NAR's chief economist, had this to say: buyers were likely anticipating further rate increasing and locking in low rates, and investors added to overall demand with all cash offers. I have some stats regarding this because overall cash sales and investor purchases increased in January. I'll also give you an update regarding mortgage interest rates as well. According to Yoon, home prices at $500,000 and below are disappearing, while supply has risen at the higher price range. He noted that such increases will continue to shift the mix of buyers towards high-income consumers. I have some stats regarding this, but I want to first talk about home prices. So here's what they had to say. This is kind of laughable. The median existing home price for all housing types in January was $350,300. That's up 15.4% from January 2021, when home prices were $303,000. And
that is ridiculous. An extra $50,000 on a home. And the thing about it that's so crazy is because our wages are not going up that much. So at some point, unless there's going to be nothing but investors buying up these homes and us just all renting, they have to make it make sense, because an extra $50,000 is probably an extra $100 to $200 a month, which sounds like a little bit. But once the interest rates start coming up, which Jerome Powell is eventually going to have to do that, then people aren't going to be able to afford a house with a 3-4% interest rate on top of the extra 50,000. So when he starts raising these interest rates, most likely this was my projection that most likely the prices on the houses are gonna start coming down. So I mean, we're gonna see what happens.
As prices rose in each region, this marks 119 consecutive months of year-over-year increases, the longest running streak on record. So my question for the National Association of Realtors is, how did home prices change compared to the prior months? They only talk about how home prices increased compared to 1 year ago. However, when you actually look at their data that they provide on their website, have a look at this. Here's the existing home prices. Again, here's 2019 through 2021. But have a look at this. January, we had $350,300 compared to last year. That's an increase of 15.4%. However, when you actually analyze this data, we're at the lowest levels for home prices that we've seen since April of 2021. Have a look at this. December compared to January, home prices actually decreased by about $4,000, but they didn't mention this in this narrative. I don't know why they don't do this, but I wish they did, because you would never know this unless you actually look at the data that they have on their website here, which is a little bit hard to find in my opinion. Any case, January's median home price reached $350,000, but the lowest levels we've had since April of 2021. In addition, for single family houses, the median price is $357,000. That's the lowest levels we've had since May of 2021. In any case, I really wish that their narrative right here would include month to month changes and not just year over year, because that doesn't really tell us the whole story. Moving on. Properties typically remained on the market for 19 days in January, meaning that when a home seller lists their house for sale, they accept an offer within 19 days in January of 2022. That's equal to days on the market for December 2021, but down slightly from 21 days from 1 year ago. In addition, 79% of the homes sold in January 2022 were on the market for less than a month. And Lawrence Yun explained that the forthcoming increase in mortgage rates will be problematic for at least two market segments. I talk about this a lot because mortgage rates have been increasing, and this is going to cause housing affordability to be more and more of an issue.
I said that, right? I'm reacting to this live. I said that as they increase the mortgage rate, because they can't stay low forever. Once they start to increase the mortgage rate, that's going to cause people aren't going to be able to afford these. Say me, for example. I'm rich, allegedly. Say I could afford $1 million house at a 2% interest rate, right? I've been looking at $1 million houses. That's probably like $3,000 a month with taxes, depending on where you're at. So let's just keep it simple. Say I can afford a $3,000 house. That same $1 million house, if it goes up probably 1% in mortgage and I'm paying a 3% interest rate on my mortgage, it's going to probably be like $3,500, like give or take. So these small percentages, they matter a lot, because when people are buying their houses, they're not going based off of how much, like the houses I'm looking for. I'm not going to be like, oh, this house is $1 million. I can't afford it. When people, the right thing you're supposed to do is your house is not supposed to be more than 25% of your income. So, and that's after taxes. So if you make $100,000 after taxes, you make $150. I'm trying to make the math simple for myself. Say you make $150,000, and after taxes, this ain't gonna add up. Maybe it'd be $125. After taxes, it comes out to $100,000. You shouldn't be spending more than $25,000 on your house. So say, just for example, say me and my wife, we both made $100,000. So $125, we both together, we brought home $250. After taxes, we made $200. We shouldn't spend more than $50,000 on a house. So that $1 million house at $3,000 a month is $36,000. That's not bad for you and your wife if you guys are both after taxes making $200,000, because you're spending less than $50,000 on your house. But say the interest rate goes up to 3% and now you're spending $3,500 instead of $3,000, or maybe you're spending $4,000 because it went up 3.5% or whatever, 4%. Now you're getting close to that $48,000 for the same house that costs $1 million. And before you know it, you might be breaking your budget simply because because the interest rate starts to rise. So when that interest rate starts to rise, we're like, we can't afford that $1 million house. Nah, let's take it down a little bit. Maybe we should try to look for houses that are probably worth like $800,000. So we're going to see.
Yeah, this is say. So first, some moderate income buyers who barely qualified for a mortgage when interest rates were much lower will now be unable to afford a mortgage. Second, consumers in expensive markets such as California and the New York City metro area will feel the sting of nearly an additional $500 to $1,000 in additional monthly payments due to rising mortgage rates. Obviously, in these markets where home prices on average are around $800,000, at least in California, it's around $800,000. We're gonna have a big increase of housing payments because mortgage rates have increased over 1% in a very short period of time. So have a look at this. I did some digging for you guys regarding this. So right now, according to the Mortgage News Daily, the average 30-year fixed rate mortgage is 4.09%. Compared to 1 year ago, it was about 3%. So about 1.1% increase compared to 1 year ago. So I did some numbers for you guys. I always talk about how this causes your housing payment to increase.
I wish I could click on this chart to see what this is. That August 20, oh, you can't even see it. This, where the hell is my mouse at? At the bottom right here. Right here. Can y'all see that? The lowest point in this chart is August. Oh, I've made the mouse invisible. The lowest point of this chart is August 2021, right? Where it drops the lowest. And that says it's at 2.75%. So that's what I'm talking about. Like, that's a big difference to go from if you bought a house in August 2021 for 2.75% versus you buying let's say stick to the same example, you buying a $1 million house for over 4%. We talking probably a payment difference of just off of interest alone, probably of easily maybe $1,000. So it's crazy.
Some numbers for you guys. I always talk about how this causes your housing payment to increase, but I never give you some examples here. So let me do that. So again, home prices on average in the US around $350,000. So let's just assume a loan amount of $300,000. So if you were to get a mortgage 1 year ago at 3%, that would give you a monthly mortgage payment of principal and interest of $1,265 per month. However, if mortgage rates increase to 4.09%, still a $300,000 loan amount, now your mortgage payment is $1,448, and that is $183 per month in additional costs to buy a house, given that mortgage rates have increased by 1.1%. That could cause some home buyers to put the brakes on their home search because interest rates have been increasing. In addition, some home buyers may no longer qualify for a mortgage. All right, I want to share some slides with you guys.
So I ran the numbers because, I found a mortgage calculator too. I just wanted to see how far off I was. So for me, I said $1 million house, right? We're going to go 2.75% because that's what the interest rate was. That's what the interest rate was in August 2021, the average. So it's $4,000 a month. Right. So what do we say? If y'all was both making $125 each, $250, that would be about $200,000 after taxes. And you shouldn't spend more than $50,000, which is 25% of your income. That came up to, can I get all fancy with y'all? I'm not going to do all of that. I put it in the same mortgage calculator online. You just Google mortgage calculator. And this is in New York. It came up to $4,082 a month. Right? So now let's just put 4.01, $4,780 a month. That blows you over your budget because that's almost $5,000. So now you're looking at $60,000. So me and my wife aren't going to say, let's get this house. Like, nah, is you crazy? Like, because at the at the expense, God forbid, something happened and you can't afford this house by yourself, it's how foreclosures happen. So you got to stick to your budget. But we're not gonna say no, let's buy this house. We're gonna say maybe we should look for a house that's $800,000. And if we can't find one in our neighborhood, we just gonna wait. So, anyways.
And also share how each of the major regions in the US fared. So have a look at this. This is again for January 2022. So right now we're at 6.5 million for total existing home sales on a seasonally adjusted rate. Compared to the past 4 years, really, we're at very, very high elevated levels, except for January of 2021 when we reached 6.6 million. However, we were going up here, and it's going to be very interesting to see, are these figures going to increase in the spring, given the fact that mortgage rates are at 4% or higher than 4%. We will have to see, but just want to point this out because in 2019 and 2018, pre-COVID, we had less home sales compared to now, especially given the fact that we have record low housing inventory. Back in 2018 and 2019, we had a lot more houses available for sale. So it just goes to show how home buyer demand still remains very elevated. So let's have a look at home prices across the US over the last couple of years. This is for January 2018. Right now we're at 350,000. The all-time record high was in around July of last year at $362,900. Still very, very elevated compared to years past. In addition to this, have a look at this. So July to now, more or less home prices have been decreasing or more or less plateauing. But have a look at this because in July of 2018, home prices were going down all the way through the summer months, and also it happened in 2019 as well. In July through December, home prices also decreased. So this is very common for home prices to plateau in the winter months. What's going to be very telling though is the spring months. Are home prices going to continue to increase? And also, are we going to have an increase of housing inventory? We'll have to see. Here's also something I found to be kind of mind-blowing as well. So this is the median home prices across the US. This is the percent change year over year. What I found to be very interesting here is that, home prices have increased 15.4% compared to 1 year ago, but the year-over-year change has been increasing for 4 months in a row. So back in October of 2021, we had 12.7% was our year-over-year change, but home prices have been increasing on a year-over-year basis for 4 straight months. Here's something I also want to point out to you guys. So here are the percentage of sales. So first-time home buyers in 2022, 27% of all home sales went to first-time home buyers. Compare that to January of last year, or January of 2021, it was 33%. So we went down from 33% to 27% in 1 year. So first-time home buyers are not buying as many houses as they used to compared to 1 year ago. In stark contrast, sales to investor and cash sales have been increasing. So we went from 15% in January of 2021 to now 22%. For cash sales, we went from 19% to 27%. And by my dumb math, this is about a 50% increase compared to 1 year ago for sales to investors and also cash sales. Days on the market has also been decreasing as well. 19 days on average compared to 21 days 1 year ago. In addition, home sales in the lower range of the market of less than $250,000 is really falling off the map here. Sales of $100,000 to $250,000 have decreased by 23%, whereas home sales of $1 million plus has increased by 39%. It just goes to show how not everyone has been affected by this pandemic that we have. Okay, let me give you a regional breakdown across the US for the 4 major regions in the US. And that'd be for the Northeast, the Midwest, the South, and the West. There's some really big differences here, so I definitely want to point this out to you guys. So in the Northeast, home sales decreased 8.2% compared to 1 year ago. However, home prices went up 6% from 1 year ago. In the Midwest, existing home sales were equal to more or less 1 year ago, but home prices increased 7.8% from January of 2021. Here's something I found to be mind-blowing though. So in the South, home sales gained by 0.3%, But have a look at this. The median sold price in January 2022 compared to January 2021 increased by 18.7%. It's pretty remarkable. And that's for the 5th consecutive month the South witnessed the highest pace of appreciation, far surpassing home price gains that we saw in the Northeast of 6%, Midwest by 7.8%, and also the West by 8.8%. So in the South, we have an increase about 10% more compared to other regions here. And Yoon had this to say: the migration to the southern states is clearly getting reflected in higher home sales and fast rising home prices compared to other regions. In the West, home sales were down 6.6%, and the median sold price was up 8.8%. So comment below with what you're seeing in your neck of the woods. Every housing market is different. And also, what's your biggest...
Okay, so that was the end of this man's video, but I also wanted to check out Graham's.
What's up, guys? It's Graham here. So as an investing...
Chill out, Graham. There was other videos that were talking about it. So we're gonna react to this one too. It's Grant Steffen's thoughts on the market crashing in 2022. Trying to do these long lives so I can get this channel monetized because it's growing, but I still don't have all that watch time. So bear with me. Let's go.
What's up, guys? It's Graham here. So as an investing channel, I generally refrain from talking about topics like this, but since it will have an impact in your portfolio and quite a few people don't understand the full context of what's going on, I thought it would be worthwhile to break down the current tensions between Russia and Ukraine, what this means for you, and how this will impact the entire economy moving forward. Because I have to say, whether or not you've been following along with current events, this is something to be made aware of, and it does have the potential to affect everything from banking, stocks, cryptocurrency, and even interest rates, while the market continues to decline from every twist and turn along the way. For example, we've already seen the market drop substantially on recent news, causing the S&P 500 to enter a correction for the first time in 2 years. Oil just hit its highest point since 2014, Bitcoin plunged below $37,000, and the question absolutely still remains, how much worse could this get, and is this just the very beginning? So let's cover everything that you need to know about the future of the markets, your money, and the economy. And don't worry, with topics like this, I don't take sides, and I do my best to remain as neutral as possible while only talking objectively about the facts. That's it. So if you appreciate the unbiased information, if you want to support the channel, it does help out tremendously if you hit the like button or subscribe. And with that said, let's begin here. All right, first on the most basic level, here's what's going on between Russia and Ukraine and why this is so important to understand, even for all of us here in the US. Now, for those not aware, up until 1991, much of Europe was controlled by the communist-run Soviet Union, and at the time of its downfall, Ukraine had the third largest atomic arsenal in the world. As a result, the United States and Russia worked with Ukraine to disarm and remove the nuclear missiles in exchange for the security that would protect them from a potential Russian attack. However, in 2013, the Ukrainian president rejected a deal that would integrate their economy with the European Union under the suspected pressure of signing a deal with Russia instead. Although
Bet he's regretting that now.
that proved very unpopular for Ukrainian citizens who began to protest throughout the region. Russia saw this and became concerned about the possibility of their neighbor, Ukraine, adopting new Western alliances. And so Russian troops took over a neighboring peninsula, sparking tension that they had violated their original agreement not to attack. Enter now the North Atlantic Treaty Organization, otherwise known as NATO. This is an alliance and treaty between countries who aim to resolve military and political conflict, build partnerships, and uphold the security of the North Atlantic. In order to join, there must be unanimous agreement between all 30 member countries. And at the core of the agreement is what's called Article 5, which is a commitment that an attack on any NATO country is treated as an attack on the entire alliance. Or in other words, if Ukraine joined and then Russia attacked Ukraine, it would force all 30 NATO members to get involved and it would become a global issue. In this case, though, Russia wants to gain more influence on the region while Ukraine wants to be their own independent country, and that's causing a lot of friction. See, Ukraine previously initially applied for NATO membership in 2008 and were informally promised that eventually they would be given the opportunity to join. But from the Russian perspective, Ukraine joining NATO would mean that their entire western border would be controlled by an alliance that they see as a potential threat. However, that was just the very beginning. In an effort to resolve tensions between the US, Russia, and Ukraine, negotiations went, well, not so good, with Russia making demands that the US and most of NATO couldn't adhere to, like not admitting any new members, banning Ukraine from joining, and prohibiting any military activity throughout Eastern Europe. At the same time, Russia began increasing their military presence near Ukraine, where the US says that they've amassed over 100,000 troops, with the implicit threat that they could use force if their demands are not met. By the end of January, the US responded back, opening up a dialogue should they choose to accept. Although negotiations stalled, tensions grew, and throughout the last few weeks, things have only gotten worse. Now, in response to Russia preparing for a potential invasion into Ukraine, and even moving further into the region, the US sent troops to the Ukrainian border as a show of support for the European alliance. They cut off Russian funding for US-owned debt. The UK announced targeted sanctions against banks and wealthy individuals to freeze assets, and potentially many more sanctions could be coming. Or in other words, if you want this summarized even more simply, there's been a long-standing tension between Russia and Ukraine, and with Ukraine aligning more with Western philosophies, Russia has threatened to use force to gain control, impacting the alliance of all surrounding nations. Of course, even though I'm certainly not qualified to give you a deeper understanding into the exact nuances of everything going on, we should talk about this in relation to the market, because there's a lot more going on than meets the eye. First, we have an increase in commodity prices like oil and gas. Like just yesterday, it was announced that oil is quickly approaching $100 a barrel while there's a potential disruption of natural resources. After all, Russia is one of the largest oil producers in the world, and when they supply Europe with nearly 40% of its natural gas and 25% of its oil, it's pretty safe to assume that prices could continue going higher. This impact extends even further, though, with Reuters saying that over 90% of US semiconductor-grade neon supplies come from Ukraine, while 35% of US palladium is sourced from Russia, meaning computer chip and semiconductor production could be even more strained. After all, these chips are in everything from cars, computers, phones, video games, electronics, solar panels, or basically anything with a computer. And that's been partly to blame for the skyrocketing costs of nearly everything that we use on a day-to-day basis. In fact, a survey of more than 150 firms found that supplies had fallen from an average of 40 days worth in 2019 to just 5 days in late 2021. And with the current tension between Russia and Ukraine, that might not go away anytime soon. Second, we got the increasing fear of inflation. See, inflation is measured as a year-over-year increase in prices, and for inflation to continue, prices have to continue rising at the same speed. Up until now, it was largely assumed that a portion of inflation would be transitory, meaning prices would go up, but the pace at which they increase in value begins to slow down over time. It would be no different than your grocery items going from $100 to $107 in one year, but then increasing to $109 in the second year, effectively meaning that inflation has slowed down to their target 2%, even though prices are still rising. However, the tension between Russia and Ukraine has renewed the fears of what happens if prices just keep rising even more. After all, gasoline makes up a large part of the consumer price index, and if oil continues going higher because of international tension, that will absolutely be reflected in our numbers. The same applies to the chip shortage coming from both Russia and Ukraine, with used cars being a perfect example. Year over year, the price of automobiles has gone up by nearly 40% due to labor, material, and supply chain bottlenecks. But just as they're beginning to come back down, they could just as well start to go back up. Depending on how much worse things get, the supply chain could be disrupted yet again by a domino effect of one exporter to another throughout Europe, causing inflation to come in worse than expected again throughout foods, daily items, and oil. That, of course, causes a snowball to number 3, rising interest rates. I know we've covered this topic before and you've heard it everywhere, but 7.5% inflation is a critical situation for the Federal Reserve, whose mission is to bring down inflation to a reasonable level by increasing interest rates. However, there is a bit of a problem. It's generally thought that the better the economy does, the more people spend their money, and the lower the unemployment is, the more likely it is that interest rates are going to be increased higher than expected because it's assumed that prices will continue rising. But
Let's go back to that one. I guess we'll talk from here. I thought this was interesting because
interest rates are going to be increased higher than expected because it's assumed that prices.
See, the problem with this whole situation right here, right? So we got a good economy, which, give or take, it's doing all right, even though things have been crashing for the last few days. Good economy. The people should be spending more, right? But the problem is the economies, everything is going up, and people like prices. Let's skip over to where the rising prices. Well, you can't spend what you don't have. So if they don't raise if they don't raise people's salaries, they don't have money to spend. But because everything was shut down during this pandemic, people don't businesses are using this time with the prices rising to also make more money, to make more profits, because of what they didn't make profits while the pandemic was going on. So instead of, they continue to raise the prices, but they're not raising people's salaries. So I would argue that the unemployment levels will still remain low, but people won't be able to continue to expend because they won't be able to afford they won't be able to afford the prices. So something's going to have to give. And I'd argue that these prices have to come down, because if supply and demand, if somebody doesn't have the money, they're not going to buy it. So the demand's going to go down.
Will continue rising. But with the current tensions, people worry that prices could see another spike higher for the reasons we just mentioned, causing the Federal Reserve to take even stronger action, which of course would begin to depress stock values. In fact, as we could see as rates rise, a large portion of the market begins to sell off, and with tech making up the majority of most indexes, they tend to suffer the most the faster rates increase. And finally, for uncertainty. Basically, the one thing the market hates is the unknown, and when inflation comes in higher than expected, combined with an unpredictable movement of Russian troops into an area that has the potential to send ripple effects throughout the economy, stock prices tend to fall as the worst case scenario tries to price itself in. It's very much the once we know the outcome, we could adjust accordingly and look forward. But this is not the situation where that could be done. Now, even though we're not sure exactly how this is going to play out, what will happen, or how easily this could be resolved, I did find it reassuring to know that historically, during times of political tension, research cited by LPL Financial found that since 1941, the stock market has on average saw a drop of 5% with an average recovery time of 47 days. On top of that, they also mentioned that the Swiss Finance Institute found that the increased likelihood of a war decreased stock values more than the actual war itself. They called it the war puzzle because there was no clear explanation as to why stocks increase once a war breaks after a prelude. Some theorized that stocks react worse to the possibility of something happening rather than the event itself. And that could really be a perfect explanation as to what's happening here. For instance, Goldman Sachs says that the market could fall 6% if tensions get worse, and the Nasdaq could see a decline of another 9% if this continues. Cryptocurrency prices also took a huge hit under the threat of rising inflation and geopolitical tension. Not to mention, some are beginning to compare its performance to that of a tech stock, which typically rallies during times of low interest rates. Of course, if the stock-to-flow model is correct, this could be a good buying opportunity before a potential rally in 2025. So if you're interested in buying the dip, the cryptocurrency exchange FTX is a place where you could buy, sell, track, and trade a multitude of cryptocurrencies and NFTs right from your phone with fees that are up to 85% less than the competition. Not to mention, you could also earn free crypto on every trade over $10, and their crypto debit card is accepted at millions of merchants worldwide. So if you want to sign up and learn more, feel free to use my link down below in the description. Although overall, in terms of the entire market, it does seem as though this is just one piece to an already very delicate puzzle of economics, where we could see a ripple effect from international tensions to rising prices to increasing rates, all of which can impact your portfolio. For myself, I know it's difficult watching your account go down in value, especially if you've only been investing throughout these last few months. But ultimately, if it makes you feel any better, there is always going to be something going on, and rarely is there ever a peaceful time where stock prices trend upwards without something scaring investors. It's simply just a part of the investing process, and the best thing that you could do is stay educated, keep buying as normal, and most importantly, don't panic and subscribe. So with that said, you guys,
Y'all still with me? I can't lie, it's hot as hell in this room, but I gotta keep the merch going. So I'm under this hoodie sweating. Anyways, next thing we're gonna watch, Just Brick sing from Minority Mindset. Is Wall Street going to crash the housing market? Let's roll the clip, please.
What's up, everybody? I am Jaspreet Singh, and do you want to know who the biggest first-time home buyer is right now? No, it's not millennials. It's investors on Wall Street. BlackRock has been buying homes around the country at record-breaking speeds, and hedge funds have been joining the party because now they're buying homes, and we're seeing institutional investors buy homes at record speeds.
I don't understand what's their point, like, in doing this. It makes no actually it does, because from what the construction worker was saying, that there's a housing market shortage where, like, between the supplies and stuff, people aren't building houses. So maybe they're projecting in the future these houses are going to be worth way more money. So they're trying to swallow up all of the inventory. But the thing about being a landlord, from what I've heard, I mean, I had a buddy who's got a couple properties, is sometimes people just don't pay. Now, I know long term it's a good money thing. I'm not saying that it's not a good asset, cake, but what I am saying is there might be better things that you can do with your money that are less stressful, like that it doesn't involve you dealing with people and them not paying and having to take them to court. So that's just my quick thoughts. Let me run back into this.
This is one of the reasons why so many people have been losing bidding wars on homes, because you have Wall Street willing to pay top dollar on homes, and they have been buying 1 out of every 5 homes in the country, and in some neighborhoods they're buying 1 out of every 3 homes in the country, and they're willing to pay, in some cases, tens of thousands of dollars over the asking price. Wall Street has already spent over $60 billion buying up homes around the country, which is very interesting because traditionally Wall Street hated the idea of investing in real estate. Your traditional investment portfolio, especially if you have any sort of money manager from a bank on Wall Street or any sort of financial advisor, is going to say that you should invest your money in cash, you should have some money in stocks, you should have some money in bonds, and you should have some money in CDs. They never mention anything about real estate unless you're investing in real estate trusts, which is something that you buy on the stock market. Part of the reason for that is if you're investing in real estate, they're not making any money off of you. So if Wall Street is pouring billions and billions of dollars into the housing market, artificially inflating housing prices, making it harder for people to be able to afford homes, are they creating a housing market bubble? And that concern is pretty legitimate, considering Wall Street has been on the forefront of a number of bubbles in the past. So what I want to do today is start by talking about what's going on and what Wall Street is doing, how this affects you, and what might be coming in the future. And before we jump into this, I want to give a quick shout out to Reventure Consulting, who made a video on the option. Now let's jump into investors in the housing on with Wall Street and the housing market. Let's start by taking a look at the growth of investors in the housing market. CoreLogic put this together, and you'll see that before the pandemic, investors were buying somewhere between 18 and 15% of homes that were listed for sale. But now, after the pandemic, it has shot up to almost 30% of all homes. That's why in some neighborhoods right now, you're seeing investors from Wall Street buy nearly 1 out of every 3 homes in a neighborhood, which is why it's so difficult for people to be able to buy homes, because you're competing against Wall Street, which has billions of dollars in their pocket, and so they can overbid on homes because, well, they have the money to do so. Now, it's nothing new that investors are buying homes. I mean, you've been seeing small and medium-sized investors buy homes for decades. That's always happened, where you have people that want to buy homes and then they rent it out. But what's new is how aggressively Wall Street is buying homes. Figure 3 shows the different classes of investors and how aggressively they're buying homes, and this bottom line right here are your large investors. That's hedge funds, those are your Wall Street banks, and you can see that after the 2020 pandemic, they have been buying homes like crazy, while your small and medium-sized investors have been slowing down because they just can't afford to buy more homes. So Wall Street isn't just pricing out people that want to go out and buy a home to live in, they're also pricing out your smaller investors. This is something that we've never really seen before, because before, anytime you'd see these big institutions and corporations invest in real estate, they didn't want to deal with single-family homes because that's the big headache. You have to deal with so many different roofs, you have to deal with so many different furnaces, and they're all located in different places in the country. That's why you'd see them invest in commercial real estate. They would buy and create these big apartment complexes. They would buy office real estate. They'd buy different types of massive real estate because it's a lot easier to manage. I mean, if you have 100 units in one apartment complex, it's easier to manage that than 100 homes spread across different cities in the country. Redfin did their own study to see how many single-family homes that investors are buying, and you can just see the number explode after the pandemic, where investors are buying more homes as investments now than ever before. So the first question that you want to ask and understand is, why in the world is Wall Street buying up all of these single-family homes? Well, what you have to understand is Wall Street is in the business of trying to get a return on their money. And traditionally, Wall Street likes putting their money into paper assets, stocks, equities, things where they can easily sell their assets and see what type of returns that they're getting. But the issue is, well, stocks have been very overvalued, and the valuations of some of these companies are extremely high. Like some companies on Wall Street are selling for
But they not high no more. Everything is down 60-70%. So
50 to 100 times multiples, which means that for every dollar that they earn, the price of the company goes up by $100. That's where these hedge funds and institutions are always looking for the next best thing. Where can we put our money now where nobody else is looking, where we can get a massive return on our money before everybody else goes? Wall Street has always had some sort of exposure to real estate, typically in the form of REITs. A REIT is a real estate investment trust, and these are companies that go out and invest in real estate. So a lot of these REITs are your corporate real estate investors. They own your large apartment complexes, they own your large office buildings, they own some of the large hospital buildings, and so they're the companies that are going out and either building or buying these massive buildings. But there's a couple issues with that right now, because on one hand, the entire office market is completely changing because of this pandemic. I mean, companies just don't need as much office space as before, so we have a massive surplus of office space in the United States, and so you have some banks and institutions on Wall Street that don't really want to touch that anymore because it's not as needed as it was before. Same with retail real estate. This is one of Wall Street's favorite places to invest their money because they would invest their money into shopping plazas and shopping malls, which used to be a very safe place to invest your money, but now because of the digital revolution, people aren't going to shopping malls as much, they're not going to shopping plazas as much, so that's just not a very attractive place to invest your money in real estate. That leaves only one type of real estate to be technology proof: residential real estate, because no matter what happens in technology, we're always going to need a roof over our heads, we're always going to need a place to sleep, and traditionally, these institutions were investing their money into big cities, places like New York and Chicago, places where you would want to live, work, and play at the same place. But because of the pandemic, many people have been moving out of the big cities into suburbs. And it's also harder right now for corporations to be able to build more of these buildings just because we still are dealing with a labor shortage, even though unemployment is still supposedly low. And we
So my question is, because I used to live in the city, is if people are moving out of the city, and I remember during this pandemic, the rent for in the city, I mean, dropped crazy. Like people were not trying to live out there. My question is, if people are moving into these suburbs, what are they gonna do when people start to move back in to like these urban areas? Because people don't just only move into these urban areas, like these city areas like Manhattan, just because of their job. Like people move there for I have no idea why they moved there, because I don't live in the city anymore, but they move there for like the skyscraping, the convenience, to be able to do things. Like where I'm at right now, like where I'm from, like literally you could walk 2 blocks and you'd find a supermarket. Pick a direction, walk, you could find a corner store. Now I have to get in my car and drive 10-15 minutes to the nearest thing. If I want to go out, like I can literally just hop on a quick train, go downtown, take like 10 minutes instead of me driving 30-40 minutes to get to the city. Like there's so many different conveniences. So and this demic is starting to slow down. So I'm wondering, like, as it slows down, as it slows down, I'm wondering if people are going to start, like, these businesses are going to stop buying these houses. But then again, I mean, these houses, but Wall Street's going to stop buying them. But then we go back and revert back to there being a low supply. So we'll see.
still are dealing with supply chain issues, so it's much more expensive and much more difficult to build these type of buildings. So Wall Street is looking at their options. where can we take this money? The stock market is overvalued. Some of these startups are overvalued. The commercial real estate market is not making any sense. We don't want to invest it into these apartment complexes into big cities because we don't know if people are going to still want to live in these big cities. And that leaves them with single family homes, which is a market that Wall Street traditionally never wanted to touch because it's extremely difficult to manage a whole bunch of single family homes. You're dealing with a bunch of different people, and you're also dealing with a whole bunch of different maintenance requests in different parts of the country. But now when you're comparing all of these options, you have some hedge funds and institutions saying, we'll take that risk. We'll start investing in single family homes. And the great thing is we don't have to compete against a whole bunch of other hedge funds and institutions because we're just competing against your regular mom and pop people who want to buy a home themselves. So when you look at all of these options, hedge funds are now saying, well, the stock market and companies are too overvalued and commercial real estate is too risky and keeping this money in cash is also risky because we're losing value to inflation. So let's go out and buy a tangible asset where we're not competing against other institutions. Let's go out and buy homes. The reason why this is so interesting to me is because I'm a real estate investor and I started investing in real estate after the 2008 crash, and that was when banks were just liquidating homes at pennies on the dollar. And I remember thinking to myself, why don't banks just hold on to these homes? Because they're now selling these homes at major losses, and if they were just able to create a system where they could renovate the homes and rent it out, they wouldn't lose as much money. But these banks were not in the business of renting homes. They're not in the business of flipping homes. All they wanted to do was lend money, and they wanted to get rid of the real estate as fast as possible, which is why they were selling real estate in some instances for literally.
So his point, this goes to show you that just because people, at the top are making money, that not all of them are that smart, because that's what I would have thought too. Like, I'm not about to lose money on a perfectly good house. I'm just going to hold on to it and sell it. But at the same time, I don't know if they would have been able to afford to do all of that, but who knows? I definitely ain't going to sell it for pennies on a dollar.
95% off. They were losing 90 to 95% of every dollar that they invested into these homes because they were just liquidating them. Now, bear in mind, now I'm from Michigan, which is one of the hardest hit markets in the country, but that's what I was seeing happen. Now you're seeing hedge funds saying, well, we don't want to miss this opportunity now, so they're buying up homes across the country as a way for them to own some tangible assets and create some rental real estate cash flow. Now, before I go into whether Wall Street is going to create a bubble or a crash in the housing market because of what they're doing, let me talk about what this means for you, because if you own a home, if you want to buy a home, or even if you want to rent a home, this is going to affect you. So pretty much if you live in the United States, it's going to affect you. Home prices are determined ultimately by supply and demand. When you have a lot of people that want to buy a home and not that many homes available for sale, this pushes home prices up. On the flip side, when you have a lot of people selling their homes and not that many people buying homes, this pushes home prices down. Right now, we are in an environment where you have a lot of people that want to buy homes, a lot of banks and institutions that want to buy homes, and very little people actually selling homes. We have one of the smallest inventory of homes ever, and so you have all these people and now all these banks and institutions coming with all this money wanting to buy homes, which is pushing home prices up. At the same time, we're also entering a market where it is going to become even more expensive to buy a home, even if home prices don't go up, because interest rates are rising. We've already seen interest rates rise quite a bit in 2022, and the Federal Reserve Bank hasn't even started raising interest rates yet. We know that the Fed needs to raise interest rates to fight inflation, and they keep saying that they're going to raise interest rates multiple times in 2022. So once the Fed starts raising interest rates, it's going to become more expensive to buy a home because now your mortgage is going to become more expensive and refinancing a home is going to become more expensive. Typically what that would mean is you would see some sort of home price correction, because in 2021 we saw home prices grow by something around 19%. So this is home prices, and we saw wages grow only by 4% in 2021. Now, home prices cannot sustainably continue growing this much faster than wages because people are not going to be able to afford homes. They're going to get priced out of homes.
That's what I said. Like, if it keeps growing at 19%, 15%, it's no way people are going to be able to buy these houses. And if they can't buy these houses, these hedge funds and these big business guys are going to be sitting on these houses. And the thing about these houses as well, just because you can't, like, if they're buying these houses at these crazy valuations, that means they're going to have to charge. So say they're looking for rent. Like, they say a good number is to get 5% for whatever your home is worth. So if you buy a house for $500,000, you should rent it for about $2,500 a month. $1 million house in my area should be rented at $5,000. No one is paying $5,000 to rent your $1 million house, especially in my area, because we're talking about New York City. I mean, these $1 million houses are stacked close to each other, no backyards, none of that stuff. No one's spending $5,000 for $1 million house. The house that I live in, this little studio, I looked it up. It's $1.5 million for this house. If I showed y'all the outside of this house, y'all would die laughing. Like literally, you would start crying. Like no one's paying $1.5 million for this house. Like these homes are connected to each other. Like you can go to Georgia and for $1.5 million, I'd be living like P. Diddy. So basically what I'm saying is I'm not gonna say what the rent I pay, but if he spent $1.5 million for this house, I want to say he should be collecting $7,500 in rent. And I ain't about to pay no $7,500. So that's why I don't get it, because even though you got people like the rate keeps rising, and it's rising mainly because Wall Street is they're overspending on these houses. How are they gonna make their money back when they can't? How are they gonna make their money back by how are they gonna make their money back in rent if people can't afford the rent? And the thing about it, if you price the rent too high, people aren't gonna spend the money. They're not gonna buy the rent. And the thing about it is roofs will still need to be fixed and repaired. All of these expenses will continue to happen. The boiler in my house was acting funny, and I'm talking to the landlord because he's an investor too. And he's like, oh man, like he's talking to me like I invest too. So we're having a conversation. He's like, man, I'm praying that this boiler doesn't go out, because that's gonna be like $10,000-$15,000. And I'm like, God dang, like that's a lot of money. Like, and that might a small expense like that alone might take out, and it's the wintertime in New York. I'm not paying no rent if I ain't got no heat. So that needs to be fixed. And something small like that, say if you paying, let's just say I was paying, I'm not gonna say let's say what I'm paying, but it's just like $15,000 might get rid of your whole year of profit if you even get profitable after that. So let's continue so I can read this comment.
Already been seeing that happen. We saw it happen in 2021. We're seeing it happen even more in 2022. And so if more and more people can't afford homes, you would think that home prices would have to go down, because now homeowners are going to say, oh, nobody's buying my home because our home is too expensive and mortgage costs are too high. So we're going to have to cut the price of our home. But now you also have to factor in the fact that it's not just home buyers that want to buy homes, and it's not just mom and pop investors that are trying to buy the homes. You have Wall Street, which is backed by billions and billions of dollars, trying to buy up homes. So for them, they don't really care about what's going on with these little mortgage rate increases. They don't really care if home prices continue going up. They will continue fronting the bill. So you have to think that even if it becomes more expensive to own a home, that Wall Street will continue buying, and that their share of home ownership will continue to rise even if regular people cannot afford to buy a home. That would in turn make renting a home more expensive, because that means your costs are going to go up with home ownership as well. Property taxes would go up. If home prices go up, your property expenses go up. And so in order to mitigate these costs, you're going to have to raise rents. But real estate is very localized, and where these hedge funds are buying homes is also very localized, which is why some areas are going to see bigger rises than others. This chart is going over the top areas that are being bought up by investors, and what you see is that San Diego, San Fran, Nashville, Orlando, Tampa, Las Vegas, Miami, Jacksonville, Charlotte, Phoenix, and Atlanta are some of the areas that have the highest rate of investors buying homes. Like in Atlanta, Phoenix, and Charlotte, you have investors buying almost 1 out of every 3 homes that's sold in these neighborhoods. So if you're in the market to buy a home, it pays to understand what's going on around you, and it looks like home prices are going to continue to rise even if interest rates go up, as long as Wall Street continues to buy homes at this rate. But there is a chance that one day these hedge funds wake up and say, you know, this home buying business is way too time consuming, is way too labor intensive, and it's not for us, so we're gonna shut it down. We saw Zillow do the exact same thing. One day they woke up and they shut down their multi-$100 million business just because they were losing money and they couldn't manage it. Now, as a little bit of a heads up, if you are in the market for a home and you want to secure a lower interest rate mortgage or refinance, you want to do that sooner rather than later, because the Fed will probably raise interest rates multiple times in 2022, which will make it more expensive for you to borrow money. So if you are interested in that, just keep that in mind. And as you're shopping around, make sure you do actually shop around, because some lenders are going to charge you a whole lot less in fees and interest on the exact same loan. And it's a whole lot easier to do that now than before, because you can just use a mortgage comparison tool online. And the following is an advertisement from our sponsor Credible, who operates a mortgage comparison website. At multiple lenders,
sir.
the process just takes a few minutes, and qualification process affect your credit score. With our sponsor Credible, qualification available. You can do that in the description below. This brings us to the third thing that I want to talk about, which is Wall Street creating a bubble by buying all of these homes across the United States? The reason why you invest in real estate is ultimately to make money, right? And the way that you make money in real estate is a little bit different than the way you make money in typical investments. In most of your traditional investments, the way you make money is you buy an investment and then you want to sell it for a profit. In real estate, it's a little bit different. You buy a home like this, and then you're going to rent it out to somebody else, and then they're going to pay you rent for you giving them access to your home. Well, what we've been seeing happen is because home prices have been going up so fast, rent prices have been going up too, but the returns on homes have been dropping significantly. To put it in perspective, when I first started investing in real estate after the 2008 crash, I was able to buy a home very easily for around $30,000 in a great area. Now, I know this is going to sound crazy. $30,000 for a home, that was the market. After the 2008 crash, especially in Michigan, you were able to go into great areas with great schools and lots of businesses and buy a home for 30 grand. So these $30,000 homes were then rented out for $800 to $850 a month. Nowadays, in today's market, that $30,000 home is selling for something around $150,000 to $200,000. So home prices have gone up significantly, but rent prices have gone up from $800 to $850 to maybe $1,100 to $1,300. So rents have gone up quite a bit, but nowhere near the amount that home prices have gone up. Now, there still are quite a bit of neighborhoods here in Michigan and other parts of the Midwest where you can buy homes with the 1% rule, which means you buy a home and then you rent it out for 1% of your cost to buy the home. So if you buy
Oops, I said 5%. 1%.
a home for $150,000, you rent it out for $1,500 a month. You just have to know where to look.
Why you ain't correct me on my math? That ain't even make no sense. 5% of $1 million would have been $50,000, not 5,000. But anyways, 1% of $1 million is $10,000. That's crazy. So that means that this apartment, this house should be rented for $15,000 a month. Insert dog face here.
But that's not the entire country. If you're from Manhattan or San Francisco or Phoenix and you're watching this, you're gonna say $150,000 home? What the heck are you talking about? But those do exist in the Midwest. But what we've been seeing happen is that a hedge fund on Wall Street doesn't care about getting the same returns as a smaller investor does, because a smaller investor needs to make a profit, because that's the money that they're going to use to pay their bills. It's the money that they're going to use to pay all their expenses, and that's also going to be the money that they use to pay themselves. Versus an investor from Wall Street, well, they might have thousands of different homes, so they don't necessarily need to make as big of a profit on one home. So what that means is they've been able to then drive up the prices of homes, just that way they can acquire more homes quicker, and they're making smaller returns. When I invest in real estate, I'm looking for a 7% cash on cash return, which means for every dollar that I
See what I'm saying, Kate? A 7% cash on cash return. I feel like an index fund does about 10 to 12%. So long term, you're going to make more money and you don't have to deal with tenants. You know what I mean? Crypto.com, I'm staking my money. 12% interest rate. Like, I don't know how long that will last, but 12% over, 7% is what he's looking for. So on average, your investor might probably make 4 or 5%. Give or take, inflation is going to take 2 to 3%, not counting these past couple years, which have been crazy. But I just think there's way less stressful ways to invest your money, like dealing with tenants and all of that stuff and stuff breaking. That's all I'm saying.
I invest, I want to make 7 cents in positive cash flow. Now, when you go into these bigger cities, you go to Phoenix, you go to Texas, you go to California, you go to New York, you're not going to see this type of 7% return. You might be seeing a 3 or 4% return. When I was in Austin, Texas, and Phoenix, Arizona, in the later part of 2021, I was looking at some investment properties over there, and they were being actively listed at a 1% return. Which means if you bought, say, a home for $100,000, they don't have $100,000 homes, but just for the sake of this example, you buy a $100,000 home, the $100,000 home is going to make you a $1,000 profit over the course of a year. Or if you want to use bigger numbers, if you go out and you buy $1 million home, you're going to make $10,000 worth of profit. Now, this 1% return doesn't really leave you with much of a margin, which means if something goes wrong, now you have to pay money.
Right. And I'm in New York, just to give back, just go back to that example. So 1% return in this house, $1,500 a year, give or take. And if the boiler breaks, that's $10,000-$15,000. So I mean, long term it's gonna work out, but short term, he's not making no money on his money
Out of your pocket. And the reason why these homes are able to sell for a 1% return is because the sellers are saying, well, rent prices are going to continue to grow by 10 to 15% a year. And if rents continue to grow by 10 to 15% a year, you're going to see a growth in your rental income. So you don't need to worry about the fact that you're not going to make any money for the next year or two. But in the future, that's when you'll start to be able to make a profits, and your home value or your real estate value is going to be so much higher that you'll be able to sell it for a profit. So let me diagram what this means. Let's say this home is now $1 million. I'm gonna go up and buy this home for $1 million, and I'm essentially gonna make no money in cash flow. I might even have to pay money every single month in order to maintain the home, but the goal is now that in a few years this home will be worth $2 million. This is the goal with a lot of real estate investors, especially when we're talking about these Wall Street investors, because this is the type of investment that fits their portfolio. They want to buy something and sell it for a big profit. They don't care if they don't make any money along the way because they want to be able to sell it for a big profit. Now, typically, if you see this type of growth, now you can finally sell the property and finally make some money, or you can refinance out and now you have some cash in your pocket, and now you finally have made some money on the home, but you don't actually make any money unless the home value goes up. This is what Wall Street is hoping for. Here's the concern. In order for this to happen, you're going to need people to be buying this home at this price. And if mortgage rates are going up, which we know that's going to be happening in 2022 and 2023, if mortgage rates go up, that means this $1 million home is automatically going to be even more expensive because your mortgage is going to be a lot more money now to buy this $1 million home than it was a year or two ago. But in addition to that, you also need the money to go out and buy a $2 million home. You need to afford the down payment, you need to afford the closing costs, and you have to afford the higher mortgage costs. Typically, in a normal housing market, when interest rates go up, that causes home prices to cool down a little bit because it becomes more expensive for people to buy homes. And if you have less people buying homes, less demand, and the same amount of supply, well, then the supply now has to adjust the prices in order to accommodate the less demand. In other words, the answer is going to depend on how and when Wall Street wants to make money. This leaves us with 3 scenarios as to what can happen. The first scenario is Wall Street doesn't care about cash flow. They continue to buy homes even though home prices go up and even though it becomes more expensive to own a home. So now we see home prices go up, we see the cost to own a home go up because interest rates go up, but Wall Street doesn't care. Less and less people are going to be able to buy homes because home affordability will continue to go down, but Wall Street keeps buying because, well, they don't care. They think that they'll be able to sell their homes for a big profit in the future, so they just keep buying and buying and buying, and this will continue to push home prices up, and America essentially becomes a renter nation because now Wall Street and hedge funds own 50% of the real estate in America, and now hedge funds are just buying homes and selling homes to each other, and the homes in America are owned by Wall Street. In that case, home prices will continue to go up and this bubble will continue to just inflate and inflate and inflate. Scenario number 2 is Wall Street says, you know what? We don't want to wait to see our profits. We don't want to wait to sell our home. We actually want to start generating cash flow. And so now in this scenario, if interest rates start to go up and unless people want to buy a home, well, then these institutions on Wall Street might say it's not making sense for us to buy these homes anymore because our monthly payments are so much higher and the rents that we're getting are not supporting these monthly payments, so we're losing water on these homes that we're buying and we can't afford to buy any of these homes anymore. If that happens, then Wall Street might stop buying homes, or they might start selling their homes because their debt payments are so high that they cannot afford their monthly costs. So if this happens, this could push Wall Street to sell their homes, and this would completely flip the market, and now you have a whole bunch more sellers. And the scenario number 3 is you have some sort of X factor, where Wall Street wakes up one day and they say, it is too difficult to manage these homes. We cannot manage all these different roofs. We cannot manage all these tenants. We don't have the infrastructure in place because it is difficult to manage these homes, even if you have a property management company, because they have to have the ability to manage all of these homes. And we haven't seen this big of a growth in real estate investments really ever. So the infrastructure to manage all this real estate is really not built yet. Or maybe we see some sort of government regulation come into play where the government says Wall Street has to go through other hoops, they have to pay other fees and fines if they want to be buying single family homes. I don't know what will happen with that. I mean, after we saw the mortgage moratorium and the eviction moratorium happen after the 2020 pandemic, I always start to include this X factor because we never really know what's going to happen. I'll be keeping you updated on my channel, and if you like the idea of staying on top of everything that's going on in the financial world, you can subscribe to Market Briefs, which is a free financial newsletter that I created. I'll put the link to how you can do that in the description below. What's up?
All right. One last one. So this last one's called, listen to Jerome Powell, the 2022 market crash has already started. And we're going to end that with this video. I kind of started watching.
Strap in, folks. The
editing on this video was pretty dope. So let's
Strap in, folks. The 2022 U.S. housing crash has already started. You just don't know it yet. And Jerome Powell, the head of the Federal Reserve, is to blame. We are seeing a catastrophic collapse in home buyer demand across America right now based on two key forward-looking metrics that predict what the housing market is going to look like in 2 to 3 months. Both of these metrics, which I'm going to reveal to you in this video, are saying that the spring 2022 housing market is going to be an absolute ghost town. We're going to see inventory explode and prices collapse. Specifically in the cities in red on this map, there's going to be a catastrophic drop-off in housing demand over the next 2 months based on these forward-looking indicators in the areas in red. And so what's really causing the problem in the housing market in America right now is rising mortgage rates. And not only rising mortgage rates, it's surging mortgage rates. According to Mortgage News Daily, the 30-year fixed rate is now up to 4.2%. 4.2% when it was only 3.2% 2 months ago. That might not sound to you like a massive increase, but it is a massive increase, and it's why pending home sales across America just collapsed by 6% month over month through February. So higher mortgage rates are basically pushing buyers out of the market. They already couldn't afford the prices. They already couldn't afford the mortgage payments. And now when you jack that 30-year fixed mortgage rate up to 4.2%, it means they can't buy homes. They can't afford homes. And if you don't believe me, just take a look at what the National Association of Realtors has to say about it in an article that just came out today. The Pending Home Sale Index, a forward-looking indicator of home sales based on contract signings, fell 5.7% in January and year over year decreased by nearly 10%. Lawrence Yun, the chief economist of the National Association of Realtors, said, given the situation in the market, mortgages, home costs, and inventory, it would not be surprising to see a retreat in housing demand. So here we have the head economist for the National Association of Realtors acknowledging that we're going to see a retreat in housing demand over the next couple months. Now, he's not allowed to say that there's going to be a crash because, after all, he works for the National Association of Realtors. But just the fact that their head economist is acknowledging that the housing market has gotten too expensive and that we're going to see a decline in home buyer demand is a big deal. And as I said earlier, the collapse in demand is going to be hardest in the areas in red on this map. In deep red in particular, you can see a place like Austin, Texas.
Why is New York not on there though? I'm feeling some kind of way. Like, y'all not going to drop the prices in New York?
Texas sticks out. And what this is measuring is the percentage change in the cost of home ownership year over year. So 1 year ago, your annual cost of ownership in Austin between mortgage payments and property taxes were $25,000. Today, they're $39,000. They've gone up by 60% in just 1 year.
In Phoenix, Arizona, it's a similar situation. The cost of ownership has gone up by 46%. Las Vegas, Nevada, it's a 44% increase. Salt Lake City, it's a 42% increase. And Boise, Idaho, it's a 44% increase. And so let me just explain to you what that means in practical terms. It means in places like Austin and Boise and Phoenix and Las Vegas, if you were a home buyer 1 year ago, you were paying 40 to 60% less in terms of your annual mortgage payments and your property taxes. But now that values have gone up so much and mortgage rates have gone up so much and the underlying tax assessments are going up, a home buyer today in these cities is paying 40 to 60% more on an ongoing basis. Clearly that is not sustainable. You can't increase the cost of home ownership for new buyers by 50% in 1 year and expect that housing market to sustain itself. I mean, just think about it, everyone. If you've been someone in Austin or Boise or Phoenix for the last year, has your income gone up by 50%? Of course not. It's more likely that your income has gone up by 5% or 3% or 7%, and that the cost for you to own a home has gone up by 5 to 10 times more than that. And this is the dirty secret of the 2022 housing market that realtors don't want you to know, real estate investors don't want you to know. They just want you to focus purely on the fact that there's cash buyers in the market and investors are buying homes. But in the long run, those cash buyers and investors are not what fundamentally determines housing demand. It's the regular American who needs to get a mortgage to buy a house. Still, over 75% of all home purchases are financed with a mortgage. So if the mortgage costs are...
You see this house right here? This house in New York and Austin, Texas is probably $500,000. A house like that, I want a house like that. In New York, in my area, it's like $4 million. Like, it's ridiculous.
Up by a ridiculous amount year over year that's going to tank home buyer demand and crash.
You see that house, and you see the house that we're looking at, and in the corner to the left of that house, you see that? It's probably a garage. In New York, that house is probably $1 million.
The housing market. In addition, we're also seeing a major collapse in another forward-looking indicator, which is called mortgage purchase applications. Data tracked by the Mortgage Bankers Association basically evaluates the amount of people applying for pre-approval on loans and mortgages so they could purchase a house. We can see that there's been an over 20% collapse in mortgage purchase applications in just the last 3 weeks. Wow. So this aligns very well with seeing a big decline in pending home sales. Why are we seeing a decline in pending home sales? Well, people aren't applying for mortgages to buy homes. And this is just the start, everyone. The 30-year fixed mortgage rate is up to 4.2%, and the Fed hasn't even increased interest rates yet. We haven't even seen an official interest rate increase. That's officially going to come in the middle of March, and they're projecting, different banks are projecting up to 7 rate hikes in 2022 to go along with quantitative tightening. I don't know if you all know what quantitative tightening is, but let me tell you right now, it's the reverse of money printing. The Fed is going to basically stop money printing in the next 1 to 2 weeks, and then they're going to start taking money out of the system, and that's what quantitative tightening is. So between higher interest rates and quantitative tightening, we're going to see basically a reverse of everything we saw during the pandemic in terms of accommodative monetary policy, and that's going to lead to even bigger surges in interest in mortgage rates, which are going to completely down the U.S. housing market, but specifically these markets in red, which have already seen such a big increase in the cost of home ownership that if we increase rates and mortgage rates any further, which we will, these markets are done. They're toast, and the spring 2022 housing markets in these cities is going to be an absolute ghost town. There are going to be no buyers. Put it down right now. Reference this video in 2 to 3 months. Austin, Texas, Boise, Phoenix, Vegas, those markets are going to be a sinking ship by the time the spring comes. You heard it here first. Now, I want to hear your thoughts about all of this, everyone. What are your thoughts on this data, on the big decline in mortgage applications and home sales, on how expensive the housing market's getting for people in the Sun Belt? I want to hear what you think. Leave a comment down below. Let me know.
All right. So that's all of the videos that I had to play, all of the information. Let's talk about it in the comments below. I'm taking this hot sweat off because the heat is pumping in here.